we'll get going because there's a lot to get through, it being the first show in the month. So that means we have Andrew McHattie with us to talk about what happened over June. And we're also going to be talking to Andrew Beale about the Schroeder BSC Social Impact Fund, which is, I think, quite an interesting investment. So without further ado, news. Only a couple of things I want to pull out today. One of them is Chrysalis, which I don't think we've talked about before on the show, and the other one is Ashoka India Equity, or Ashoka India Equity, which is trying to change its investment objective or remit. So Chrysalis first. So both of these funds actually launched in 2018, this one in November, and it raised £100 million at the time, which I think was less than it was after. But actually, it managed to trade a premium for quite a long time. So it did rake in a huge amount of money, as you can see there. There's a little chart showing you how much cash and how many shares they had to issue to get that cash. So the really big issue is the one in March 21, when actually the number of shares they issued was the same as the amount they had to issue to raise 185 million in 2019, which tells you a story about the NAV and the share price going up. It actually started off looking extremely successful, as we know. So there we go. NAV climbing, share price climbing. Then we get to the period when it looks like inflation means we need to raise interest rates and sentiment turns against growth stocks, and everything starts falling away. The NAV hasn't fallen by that much yet, to be honest. So the end March NAV is 211.7. And I think today the NAV might be about £1.80, but we'll come on to that in a minute. As I said, it traded the premium for a long time. That sort of came off the rails a bit in March 2020, along with everything else. But it did recover fairly quickly. So it was still issuing stock in October, as we saw in the previous chart. And there's been sort of in and out of premiums and discounts since then. But obviously, the really big discounts emerged since things changed in the beginning of 2022. And here it is in the growth capital sector. So this is a slightly peculiar bunch of funds. Jade Road, I wouldn't pay much attention to. It's got an Asian focus. It committed the cardinal sin of deciding it could raise money at a discount. And everything it touches has not gone really well since then. And now it's on a probably well-deserved 87% discount. Peters Hill's a very different animal, and that's a sort of fund of asset managers and alternative assets, and so really not much like Chrysalis. Schiehallion is very similar, so too probably I think is Schroeder UK Public Private, and although it's got a specific space remit, it's the same sort of thing with Serafin, that we're looking at stocks that are not necessarily profitable now, but are designed to be sort of profitable way out in the future. And because these things are often valued on discounted cash flows, rising interest rates make these things look less attractive, and so big discounts opened up. Obviously, we haven't really got much of a history to look at yet with these things, but Chrysalis's NAV returns are still looking pretty good, and it's still way better than Schiehallion. And I don't really understand, I've said this a number of times in articles and things, why Schiehallion hasn't been hit as hard as Chrysalis. It doesn't really make sense, but there we go. So as I said, NAV at the end of March 211. Within that, the big moves probably were Starling being written up, which is the UK Challenger Bank, and Klarna, which is the buy now, pay later Swedish thing, being written down. We'll come back and talk about those a bit more in a minute. It did achieve its first full realization, which is I think called Embark, which got taken over, and that freed up some cash. There's one investment that they made that didn't work out quite early on, which is Growth Street, which was a P2P lending product. That's in liquidation, so that paid back £1 million. And they've also been selling stock in Wise, the foreign exchange firm, and that's freed up some money too. Against that, they topped up the investment in Smart Pension, which is a relatively recent investment, but they've put now £75 million into, and it seems to be doing okay. And also Sorted to let it buy a another company called Plixit. And they also topped up the investment in THG, which is probably the thing was the most sort of controversial thing in here for a while. Did amazingly well when it IPO'd, was for a time one of the biggest holders in the fund, but has come back an awful long way now and just rejected 2 takeover bids and seen its share price decline a bit further. So jury's out on that one, I think, but the managers are quite optimistic about its future. Anyway, all of that leaves it with these investments and 55 million of cash. So starting first, because that's the biggest investment by quite a long way now, it's valued on the basis of a very recent funding round. So that valuation is real. It's also profitable, and it's been profitable for quite a long time. And the key to it, because it's a bank and it's got quite a chunky deposit base, that it doesn't have to pay much to have sitting there. It's now got an opportunity with rising rates to make quite a lot more money, and that should increase the profitability at no end. They've also been trying to beef up the lending side. So a lot of that cash has been sort of relatively sitting there idle until recently. But the fundraise was to help them make more acquisitions. And they've been buying things like books of mortgages, which helps obviously, again, with the profitability. But it does expose them now to mortgages they weren't supposed to before. And then I suppose there's a question mark. We'll have to wait and see how profitable that book of business is when, if we have a downturn in the housing market. I think they'd be reasonably conservative with what they've been doing. The plan was for this business to IPO in 2023. Obviously, IPO markets are very much shut at the moment. So we have to wait and see what will happen with that. But I do think this is probably a very good investment, and it counts for about 45p of the NAV. So that's almost half the share price, if you put it a different way. And that probably is okay. So that, I think, underwrites the value of the whole fund, if you like. Then we got Klarna, which was valued at 45 billion. They cut it to 30 billion when they did the March NAV. And it's now room to be raising cash at 15 billion. So that would take about 20p off the NAV if that happens. There's been lots of stories around that in the press. Lots of people don't like buy now, pay later. I think in its defense, it's not encouraging people to borrow huge amounts of money. But we just have to, again, wait and see what happens with this. It's not profitable at the moment. The team thinks it might be profitable next year. But there's sort of slight question mark over that one. Against that, the WeFox investment that they've got, which is software for insurance companies, and actually has a book of insurance business of its own as well. That seems to be doing extremely well, and is rumoured to be raising cash at almost double its last valuation, and that would add as much as the Klarna would take off, more or less. So, on a kind of round trip basis, those two things, if they might net off against each other. So again, that means the NAV is not too bad. I think the big news in all of this, and the thing that was taken really badly, was that they're not planning to buy back stock. And I understand why. It's one of the things that I really berated Woodford Patient Capital for, is that it spent all its money and borrowed money and then didn't have cash to support the portfolio through difficult times. And so if you don't participate in a down round when something's trying to raise money at a low valuation, you can be hugely diluted. So that could be extremely expensive. So having the cash on side to support the existing portfolio is probably a necessity, really. They reckon that there's about, sort of, on average, 14 months of runway before these things need to come back and raise cash. Obviously, it's an average, and that varies quite a lot. So we could see some fundraisers well in advance of that. But I think it does make sense to do this. And if we were switching the thing and saying we're trying to wind it up instead, even then I'd still say probably you don't want to be buying that stock, because I think you want to be supporting the existing portfolio. So to me, that makes sense, even though it hasn't gone down very well. The other thing that everybody hates about it is the performance fee. The board is very cognizant of that. It was taken quite badly. And they've been reviewing how to change that going forward. So they've been talking to the 20 largest shareholders. I think we're going to see some news on that later on this year. So all in all, I am starting to wonder if we now looking at, we're maybe close to the bottom in this. The NAV will probably fall again, but by nowhere near as much of the share price. And it does look to me like it's on a really sizable discount. And if we are possibly seeing an IPO of Starling next year, I'm not saying that's going to happen for sure, that would crystallize probably quite a big upside on the existing valuation. So there's kind of like option value in there that I think is interesting. Anyway, that's that one. Ashoka has been a great investment. It's done extremely well since it was listed. Much more, much faster in this period here, through the rebound from COVID. Tended to trade at a premium, which is obviously been quite good news for it. So it's now out to 193 million market cap. They're growing, second largest fund in that Indian sector. It's the only one that trades at a premium. And its performance is well ahead of everybody else. And that just is testament to the quality of the fund manager, I think. When it was launched, it only got £45 million. And so the fact that it's been trading at premium and able to issue stock has helped it expand. And it's now up to about 193 million market cap. So we're getting on towards 200 million of assets, that sort of level. There's no base management fee, and that distinguishes it from the competition. But there is obviously a performance fee, and that's the manager's been earning that. What they're planning to do now is change the investment policy, so they're going to double the number of stocks in the portfolio. And to my mind, that makes me a little bit uneasy, because it is quite a big change in the approach. But the rationale kind of makes sense. So they like the ability to hold small and mid caps, but they're worried that with sort of like £8 million position in a 25 per stock portfolio, that's probably a bit too big for a small and mid cap. They'd really like to be able to trade in and out of things, because the Indian market can be quite volatile. Does that make sense? And it's not uncommon for things to have 100 stock portfolios. So from that point of view, it's not the end of the world. But we have been used to him seeing this thing being run with a concentrated portfolio. So it is quite a big change. The alternative would have been to say, let's stop growing the fund and actually start handing cash back the way that River and Mercantile Microcap does. Obviously, that's not great for the fund manager's bottom line. And so that's probably why it got rejected. So I think I'm okay with this, but I think we need to keep an eye on whether that actually does start to dilute the performance going forward. It's just something just so the jury's out on a bit. I'd like to carry on to see that being successful, because I actually do hold a few. That's enough from me then. I'm going to hand over to Andrew.
Terrific. Thanks very much, James. Interesting stuff, as always. I do keep a close eye on Chrysalis, and I think you're right that there's a tendency when sentiment is so negative to just dismiss it, but there's a lot of value there. And it does also move around a lot on a daily basis. So if you are trying to finesse your access points, you might be able to pick it up on a down day at an interesting price. So let's have a look at what's been going on, what the gains are over the last month. At the top, we still have the China trusts, which I talked about last time. So I won't go over that again, except to say that I think the gains have been extended a little bit. And I do think it's reasonable for investors to have exposure to the world's second largest economy in their portfolios. But I would just caution against getting overexcited by these recent gains, because I think there's a great deal of political risk and risk of further lockdowns there, because the zero COVID policy is very much still in place. But there were a few gains scattered around. The two I'd just like to talk about today are Princess Private Equity and Odyssey and Investment Trust, because those stand out to me because it's not obvious why they're on the list, because both private equity and smaller companies have been quite weak. Clearly, the fallers have been much more extensive, and those growth-oriented stocks are still very much to the fore, with Seraphim Space on the list at the top there, Chrysalis Investments a bit further down, and our old friend Schiehallion Fund, which we've both been talking about for some time, actually. But I'd just like to focus a little bit on the commodity trusts, which have had some quite severe falls, around 17% over the last month, and a couple of the private equity trusts as well that have also fallen. So let's go back to the rises then, of Princess Private Equity. I wanted to try and figure out what had happened here, and why the shares have gone up 14% over the month. It's definitely bucked the trend, because in the private equity sector, prices are on average down by 8.5% over the month. And that's for the obvious reason, really, that as public markets have come down, so investors are pricing in the lag before private asset values are also marked lower. But I couldn't find any particular news flow here on Princess Private Equity. So I had to dig around into the trading data, and there were no massive trades either. And it's not because the NAV has been doing anything extraordinary. It went down modestly in April, just less than 1%, and then down again in May. So I think all that's happened here is that there has just been a bit of buying, and presumably the market is a little bit thin, which is why we've seen this quite sharp increase in the share price, which has narrowed the discount. You can see no real movement in the NAV. So the discount has come in from 21.8% a month ago to 13.9% now, which makes it the narrowest discount in the direct private equity sector. So without any comment on the quality of the trust at all, I think it's probably a little bit more vulnerable than some of the other trusts in the sector now. Because I couldn't find any reason at all for the price going up now, I'd be interested to see if it settles back down again. The case is a bit different, I think, for Odyssey and Investment Trust, a smaller companies trust. This one, again, very much bucking the trend. Shares were up 8% over the months, and the UK smaller companies sector was on average down by 7.5%. And here again, we've seen the rating change. So the shares have gone to a small premium from a discount. But we have seen this happen before with Odyssey. I mean, this is a 1 year, sorry, a bit less than that, share price chart. We can see that at various times, the shares have been at a premium before. They fell to a discount earlier in the year. But there has been a lot of variability here. So this is just a continuation of that, I think. And here there has definitely been some buying volume, which I'll show you in a moment. There's some quite interesting data on that. There's also a specific reason, I think, why investors might have focused on the trust, which is that its third largest holding at the end of March was in Euromoney Institutional Investor, which has received a takeover bid already at a nice premium. But I think there's an expectation that there could be a bit more action to come there as well. So possibly more value to be unlocked. So I think with Odyssey, and it's actually reasonable to see this price rise and to explain it. I'll just share this bit of data here that I get from Librum Securities because I find it very useful, and this shows the amount of trade in shares relative to their market cap. So rather than just showing us that Scottish Mortgage and 3i are the most liquid trusts, this is on a relative basis and shows us basically where the buying interest is relative to market cap. This is from a couple of days ago, 29th of June, and we can see Odyssey in here quite high up on the list. 0.8% of its share capital was traded the previous day. So that's quite interesting just in pinpointing which trusts are receiving attention, and Odyssey clearly has been. The other thing I would just point out here is that the trust has actually done very well from IPOs since it launched. It's had a few takeouts in its portfolio, SDL, Clinigen, Vectura, Consort Medical. And I think no fund manager ever admits to targeting trusts that it thinks might be taken over, but often they're looking at the same attributes as other buyers. And it's quite interesting that Odyssey has actually done very well from takeovers. So the Euro money one will be added to that list. So moving on to the downside, commodity trusts have come down quite sharply over the last month. And I think this is really entirely due to the macroeconomic picture. These are highly cyclical trusts, and effectively, as recession fears have mounted over the last month, so they've come down. And I think a handy way of measuring this is with a broad commodity index. So I've used the S&P GSCI index, which over the last year here has been very good, up 30%. But over the last month, it is down almost 11%. And I think that pretty much explains the fall in commodity trust prices. Those are clearly very cyclical, very macro influenced. So I think the explanation is no more complex than that. Moving on to private equity, I think this is much more nuanced. And I think outside possibly of the high income generators, this is really one of the most fascinating sectors at the present time, because the market is really functioning exactly as a stock market should in assessing all of the information it has and trying to figure out what the future will look like and pricing things accordingly. And that's why in this current negative environment, the discounts have widened out so massively, because they are anticipating falls in future valuations. And that's reasonable because there is a significant lag here. And many of the NAVs in the sector that we're currently looking at are actually based on 31st of December valuations or possibly 31st of March, but they're definitely not up to date. And if they are marked to public market comparables, we will see them come down. So I think most managers are expecting some valuation compression here in the sector. And that's worth bearing in mind when you look at the current news flow, which is still actually pretty good. There's lots of excellent realizations been made in the last month from HG Capital, 3i, ICG Enterprise, Oakley Capital, all announcing good exits at significant uplifts to the carrying value. So these managers are still doing a good job and they are still making good investments. I just think that the underlying valuations in their portfolios are bound to be marked down to some degree. And so the job really for us as investors is to gauge exactly how significant that haircut will be and whether the current wide discounts are pricing it in or not. And I do think there are some opportunities here to buy into some high quality trusts on much lower ratings than we would normally find. And really, this is a similar argument to the one about Chrysalis, that perhaps investors are not focusing as much as they should on the quality of the portfolios here and what's in there. So these two trusts that I mentioned at the beginning, Pantheon and HG Capital, are both, I think, considered to be pretty good quality trusts. Pantheon is extremely diversified. It's a fund of funds. It's a large liquid trust. It has a very strong balance sheet with 9% net cash. And this really isn't the kind of trust where you'd expect to see a near 20% drawdown in the shares over a single month. It's not normally that volatile. And it's fallen to a mammoth, 45% discount, which I'll show you in a moment, is really much wider than it has been. And HG Capital is one of those trusts that if you've been in the industry for a long time, you'll know it has an absolutely outstanding track record. And certainly it's one of those where I've often wished I'd owned considerably more. Over 5 years, its NAV is still, at this point, up 194%. I think it has been marked down partly, though, because it has a tech bias. It always has done. That's part of its raison d'etre, that the managers have these sector specialist areas, and one of those is technology. But again, here the shares have been thumped over the last month and have fallen to a 27.8% discount, which is really far, far broader than it normally is. I do remember looking at these shares about 6 months ago, thinking that I really ought to be re-recommending them at some point, but they were on a premium and I couldn't quite stomach that. So that was a lucky escape. So here's a longer term chart, a 5-year chart for Pantheon. And this shows that the shares actually do typically trade on a significant discount. But you can see that it's really widened out very, very considerably of late. And I suppose the difficult judgment that we all have to make now is how that gap is going to be closed. The likelihood is it will close, but it could close, of course, with the share price coming up, or it could close with the NAV coming down, or a mixture of the two. I suspect it may well be a mixture of the two, but my sense is that if you're buying in at this kind of discount, you can take considerable comfort from that, because the trust is widely diversified, and I think should recover quite well when the economy does, or public markets do. So I think that's very interesting. And much the same applies to HG Capital, although here you can see that, again, 5-year chart here, over time, the shares have traded much closer to the asset value, and certainly they've traded on a premium quite a few times over this period. And so this very wide discount that has now opened up is highly unusual here. And to some degree, that does reflect the unusual circumstance in the market, but it could also be an overreaction. And I think if you're an investor thinking about adding well-proven quality investments to your portfolio at a cheap price, then the private equity sector, I think, could prove a pretty fertile hunting ground at this time. All right, we'll see. That's it from me. Thank you. Thank you very much, James.
Thank you, Andrew. It's very interesting. And actually, I got Pantheon and HG in my portfolio. So, yeah, I'm sharing your view on the quality of those two. Right, now, let's